you want an exposure to a market or an
Everything they need in one place.
Be the world's foremost authority on
Individuals, advisors and institutions.
Hello and welcome to Morningstar. I'm Emma Wall, and here with me today is Paul Woolley from the London School of Economics to discuss how short-termism creates anomalies in the market. Hello, Paul.
Hello.
So I thought I'd start by asking you, what is momentum?
Momentum, in a word, is trend following. It's buying stocks that are, or bonds that are going up and holding them for a period. I mean, it's a short-term strategy of buying what's going up, or indeed selling what's going down, and then closing the position at the end of, say, 2 or 3 weeks or 2 or 3 months.
Because herding could have a negative effect on investments, can't it? But momentum is a strategy that people use and then can make gains out of it.
Yes, they can. Momentum means just following fund flows. It's got nothing to do, it takes no regard at all of the fundamental value of the business, or if we're talking about equities, it takes no account of the dividends, the earnings and so forth. It is simply following the movement of funds that are sloshing across the markets constantly.
And it's one of the sort of byproducts of short-termism, isn't it, which we're becoming increasingly obsessed with as an investment market.
I define short-termism actually as being momentum, and I identify long-termism with actually investing on the basis of fundamental value. I mean, that is a very important distinction. Think of, I mean, people have been struggling for 40 years to nail the question of what is short-termism. Well, if you identify it as being momentum following fund flows and investing on the basis of fundamental value investing, if you like, as being long-term.
And how does this marry with the concept of the benchmark? Because you've just given a talk at Morningstar Investment Conference in Europe, and benchmarks are something that's quite close to Morningstar readers, and they are, I feel, either increasingly obsessed with them to the detriment sometimes of their portfolio, or frustrated with them, and they'd rather their fund manager freed themselves from the shackles of the benchmark. But it does really drive performance, doesn't it, a benchmark?
Okay. First of all, let's define benchmarks, what benchmarks we're talking about. We're talking about a market cap-based, i.e. the current market price-based, so an index, whether it's a national or a global index. If you have that as a benchmark, you're actually, bear in mind just what we've been saying, that prices are driven not just by the underlying value of securities, but by fund flows moving. Well, similarly, the benchmarks get distorted. Both the aggregate benchmark, the value of the national index, or indeed the valuation of individual parts of that, whether it's industry or some segment of the market, like the high tech in the tech bubble 15 years ago. I mean, technology stocks got ridiculously overvalued, and the index had 45% allocated to this ridiculously overvalued sector. So the benchmarks get distorted, and to chase benchmarks also you need to use momentum to chase that position. So you've actually got a double whammy against you.
And is the answer then scrapping benchmarks altogether?
There'll always be benchmarks in terms of indexes of what the market's doing. But it is best, if you're a long-term investor, to focus on fundamental value as far as you can, or to get your manager to focus on investing on the basis only of cash flows, because that is the only way that you win. Momentum may win in the short run. It's like the hare and the tortoise. Momentum may win in the short run, but unless you're extraordinarily lucky, many times in a row over a long period, you will lose by using momentum. And in fact, you provide the opportunities. Momentum investors collectively provide the opportunities that the value investors exploit.
Paul, thank you very much.
Fine.
This is Emma Wall for Morningstar. Thank you for watching.